Hey everyone, welcome to the next episode of our Contra investing series where we look at businesses that are fundamentally solid but are going through a phase of disappointment. Either because growth has slowed, narrative has changed, or market expectations have reset. In today's video, we'll talk about Indian Energy Exchange, IEX. At one point, IEX was considered one of the highest quality monopoly-like business in Indian stock market. Strong cash flow, high ROE, asset-light model, and dominant market share. But over the last few years, its stock price has been a big underperformer. From its peak in 2021, IEX is down more than 50%. So naturally, investors are confused. Is IEX monopoly over? Is power trading becoming commoditized? Will government regulation kill the profitability? Or is it just a classic case of expectations correcting? Interestingly, in last 2 years, public holding in the company is consistently reducing and institutional holding is consistently increasing, except for latest September 25 quarter where public holding has increased and institutional holding has reduced. Overall, in this correction phase, weak hands have reduced stake and smart money has shown confidence. So as usual, we'll analyze IEX using our 4-point contra investing framework and see whether it still deserves a place in long-term portfolio or not. Alright, let's begin. So first of all, the question is IEX business fundamentally strong? And here we look at three things: business model, management quality, and balance sheet. Okay, let's start with business model. To understand IEX properly, we first need to understand why it even exists. So for decades, India's power sector was built around long-term PPAs, that is purchase power agreements. These were 15 to 25-year contract between power generators and DISCOM, that is power distributor. In theory, this ensured stable power supply and predictable pricing. But over time, this model started creating more problems than solution. The biggest issue with long-term PPA is rigidity. DISCOMs are forced to commit to capacity years in advance, even though power demand is highly uncertain. Industrial demand fluctuates, seasonal demand varies massively, and economic cycles are unpredictable. Yet, DISCOMs still have to pay fixed capacity charges even if power is not consumed. This has led to a surplus power in the system and severe financial stress for DISCOMs. The problem became even more acute with fuel price volatility. Coal prices, imported fuel cost, and gas availability, it keeps changing. But PPAs were locked at a fixed term. This created a mismatch. Generators struggled with margins while DISCOMs struggled with losses. Then came renewable power, which completely broke the traditional PPA logic. Solar and wind power are intermittent by nature. You can't lock a 25-year baseload contract for power that depends on sunlight and wind. As renewable penetration increased, the grid's biggest challenge became balancing demand and supply in real time, not just generating capacity. This is exactly where IEX emerged as an alternative. IEX operates a digital exchange platform where electricity generators, DISCOM, open access consumer and industrial buyers trade power. It allows power to be bought and sold only when needed, let's say for a day, an hour, or even a 15-minute block. So here, instead of committing for decades, DISCOM generators and large industrial consumers, they can manage short-term mismatch and then let's say sudden demand spike or outage or renewable variability through the exchange. In simple words, PPAs provide commitment, but IEX provides flexibility. Over time, IEX has become a critical part of the power ecosystem, not as a replacement for PPAs, but as a necessary layer on top of them. As the power system becomes more complex and volatile, reliance on short-term market naturally increases. Now, from business model perspective, IEX is extremely clean. It does not own power, does not take price risk, and does not deal with receivables. It simply provides a digital platform for price discovery and charges a small transaction fee per unit of electricity traded. The model is asset-light, cash generative, and has a very high operating leverage. Since IEX has early mover advantage, it built a strong network effect where more buyers attracted more sellers and vice versa, making it very difficult for new players to disrupt IEX market. As a result, it controlled nearly 85 to 90% market share in power exchange volume. But something happened recently that has put a big threat on IEX near monopoly in power exchange, and it resulted in sharp decline in its share price. We'll come to that shortly. For now, let's look at the management quality. While evaluating management quality at IEX, the first thing to understand is that it is not a promoter-driven business in traditional Indian sense. It is run by professional management. So the lens here is not visionary founders, but execution, governance, and capital discipline. One clear positive is that IEX management has stuck to its core business. Despite sitting on a cash-rich balance sheet and generating strong free cash flow, they have not chased unrelated diversification or flashy growth story. The focus has remained on strengthening the exchange platform, launching new market segments, and staying compliant in a highly regulated environment. Governance standards have also been strong. Disclosures are clean, accounting is straightforward, and there have been no major red flag as such. Management commentary also tend to be very calculative and conservative, which aligns well with the nature of their business. Third, if you look at the balance sheet, IEX is one of the cleanest balance sheet you will find in the Indian market, not just within power or utility, but across sector. Companies completely debt-free and consistently generating strong operating cash flow. It does not require capital to grow volumes because the exchange model is inherently asset light. There are no plants, no fuel risk, no inventory, and no receivable stress. Once the platform is built, incremental volume comes at almost zero marginal cost. Another important point is negative working capital. IEX collect money from participant quickly and settles trade effectively, which means cash keeps accumulating on the balance sheet. This gives the company financial stability even during periods of regulatory uncertainty or volume volatility. Because of this structure, IEX has historically delivered very high ROE and ROC, often north of 40-50%. So if we conclude, is IEX fundamentally strong business? Answer is yes. But, and this is important, business quality alone does not guarantee great stock return. Regulation plays a far bigger role here than management or balance sheet strength, which means the real debate does not start at is IEX a good business? It starts at how much growth and profitability market will allow it to earn. And that takes us directly to the next and most important contra question. So second question is, are the current issues temporary or permanent? To answer this, we first need to go back to what happened during COVID because that period created unrealistic expectation around IEX. So during COVID, something very unusual happened in power market. Since there were lockdowns, factories were shut and demand collapsed. Since the supply was more and demand was less, short-term power was available at much lower price. Hence, DISCOM started buying power from IEX. As a result, volumes on IEX surged. At the same time, the business model showed its true operating leverage. Company's revenue jumped, profit expanded, and cash flow expanded big time. Since IEX is an asset-light, high ROE business, the market quickly started viewing as a near monopoly platform with stable and predictable earning. This led to massive re-rating. IEX share price zoomed during the COVID period and valuations moved to insane levels. Now post-COVID, power demand normalized, fuel supply improved, and the system moved back towards a more balanced structure. Volume growth continued, but not at the explosive pace that was seen during the COVID period. At the same time, regulators stepped in to reduce transaction fee. That reminded market that IEX operates in a regulated ecosystem, not a free market monopoly. But the biggest overhang came from market coupling. Now this is very important. So IEX was not just the biggest exchange, it was the place where power itself was discovered. Whoever controlled price discovery controlled the market. Buyers and sellers came to IEX because that's where the real price was formed. This is what gave IEX its monopoly-like power. If we compare it with stock market structure, brokers like Zerodha, Grow, ICICI Direct or HDFC Security, they don't discover prices. They only correct the orders. The actual price discovery of stocks happens at NSE and BSE. Earlier, IEX was more like NSE itself. It collected order, matched them and discovered prices. That's where its monopoly-like power came from. Market coupling changes IEX role to something closer to a broker. Exchanges may still collect bids and route orders, but price discovery shift to a central system that is controlled by the regulator. In that setup, no single exchange owns the price anymore. So even if IEX continues to handle most of the volume, just like Zerodha handles a large share of retail trade, the economic power reduces because pricing and market control sits somewhere else. This is why the market reacted so negatively. Investors were not worried about IEX losing volume. They were worried about IEX losing its NSE-like position and becoming more of a utility or execution platform. And that was the reason behind derating of IEX. Having said this, market coupling does not break the business model of IEX. Power will still be traded. Short-term market will still grow. Exchanges will still be required as execution and order collection platform. IEX will still benefit from volume, network familiarity and scale. In fact, in the recent con call, management has given a very good guidance of 15 to 20% volume growth in FY26. On FY27 guidance, while management mentioned it's difficult to say anything, but they have been achieving a growth of 20% volume in last 5 years on CAGR basis and should be able to achieve it in FY27. Now next question is the long-term demand story intact? So first of all, India's electricity demand is structural. Power consumption continue to rise due to urbanization, manufacturing growth, rise of data center and AI, then EV charging infrastructure and rising per capita usage. Plus now BESS, that is battery energy storage, is also gaining a lot of traction. No matter what happens to fuel prices or policy headline, country will need more electricity over time. At the same time, the nature of power generation is changing. Renewable energy is taking up a larger share of grid and renewables are inherently intermittent. Solar and wind does not produce power when demands want it. They produce when nature allows. This increases volatility in the system and makes real-time balancing far more important. This is where short-term power markets become critical. Long-term PPAs cannot efficiently handle this volatility. They are rigid and backward-looking. So there will be need for short-term power trading and IEX sit right at the center of this transition. Even if pricing power is regulated, volumes are likely to grow as more power shift to short-term market, renewable penetration increases and participants prefer flexibility over long-term commitment. Then another important point is that market coupling does not reduce the demand. It only changes pricing discovery. Power will still flow through exchanges and IEX, given its scale, is likely to continue handling a larger share of those volume. So while IEX may not enjoy monopoly economics anymore, it remains a critical player in Indian power exchange ecosystem. Then another important point is the initiatives that IEX has taken to expand its scope of business. For instance, IEX has been steadily expanding beyond buying or selling power one day in advance, which is called day-ahead market. It has launched and scaled products like real-time market to trade power just a few hours or even minutes before delivery. Then term ahead market, where power can be bought or sold for a few days, weeks or months ahead. Then green day market, which is specially designed for renewable power like solar, wind and other green sources. It helps buyers meet renewable purchase obligation and allows renewable generator to sell power transparently without long-term contract. All these offerings should result in increase in volume for IEX in the future. Then there is IGX, Indian Gas Exchange. While IGX is still small in contribution, it is also strategically important. India's gas market is underpenetrated and fragmented, very similar to where the power market was a decade ago. If gas trading gains traction over time, IGX gives IEX, another solid growth driver beyond electricity. Then IEX is also exploring international opportunities, especially in neighboring and emerging market where power exchanges are either at a very early stage or still being formalized. Now let's move on to the final question. Now final question is, has valuation reset? So IEX stock price performance over the last few years is a classic example of valuation running far ahead of business reality. During COVID, IEX was seen as a near perfect business, asset light, monopoly like, high ROE and benefiting from power market formalization. The market extrapolated this too far. Valuation expanded sharply and stock traded at 80-90 times multiples of earning during its peak. Once discussion around market coupling started, the core assumption of monopoly pricing broke. Even before coupling was implemented, the fear of regulatory intervention was enough. Investors quickly realized that IEX is not just a technology platform, it is a regulated market infrastructure and regulation can cap returns. As growth visibility weakened and regulatory risk increased, stock went through a prolonged derating. But after the derating, today valuations are far more grounded. IEX now trade at a much lower multiple compared to its peak. So in my opinion, valuations have clearly reset. The expectations are much more realistic and that's where the contra angle comes in. The key question is no longer will IEX be a multi-bagger again. The real question is the market now underestimating the durability of IEX business? Here one can ask what smart money is doing with IEX. So the weak end of public have consistently reduced stake in IEX since March 24, and both FIs and DIs continue to buy every single quarter. However, in latest September 25 quarter, FIs reduced stake and public holding has increased. This happened when regulators finally announced the market coupling. Meanwhile, two institutional investors I respect a lot for their value investing style and long-term investment approach have accumulated stake in the company. First is Parag Parikh Fund that has massively increased allocation in company in latest September quarter. And second is MIT that has more than doubled its stake in last 3 years. Technically, IEX is still trading below its 50 and 200-day moving average. So if we step back and look at IEX, the picture becomes more clear. Fundamentally, nothing is broken. IEX remains a critical part of India's power market infra. Electricity demand is rising structurally, renewable penetration is increasing volatility, and short-term power markets are becoming more relevant with every passing year. Volumes are likely to grow over time, irrespective of near-term regulatory noise. However, what has changed is the nature of business from investors' perspective. IEX is no longer a monopoly-like platform with unchecked pricing power. Regulation, especially market coupling, caps how much economic value company can extract. That means future return will look very different from the COVID era phase. The stock has already gone through a long derating and valuations have reset, expectations have cooled, and narrative has shifted from perfect business to a regulated infrastructure platform. In that sense, a lot of bad news is already priced in. So is IEX a counter bet? Yes, it is a counter bet for investors who believe regulation risk is largely priced in, volumes will continue to grow structurally, and business will remain a critical part of India's power market. If market coupling turns out to be less disruptive than what people are fearing today, there should be a good upside from current level. However, if market coupling plays out fully, IEX still survives as a high quality cash generative utility like business. In short, the downside look limited because the business is structurally important and balance sheet is strong. But yes, the upside may remain capped at the moment until market gets more clarity on the real long-term impact of market coupling. By the way, in the latest con call, management also clarified that market coupling has been issued, but coupling has not happened yet. So the market would keep a close eye on this development. So if you're looking for quick gains, IEX may not live up to your expectation. But for long term, it can still be a strong compounding story. Of course, for that you would need a lot of patience and conviction, and that is generally missing in majority of retail investors. So this is it for this video. If you find it interesting, do share it within your circle and you tell me in the comment what is your take on IEX. Also, if you want me to cover any specific company in this Contra investing series, let me know in the comment. I'll see you next video. Till then, take care.